Good afternoon, entrepreneurs. We're gonna talk about setting up your business structure. A business structure is a vehicle that is supposed to assist you to actually accelerate your business growth. So when you do not have a clear structure of how you're gonna build your business, you will also struggle with your business model. You will also struggle with capacity and capability on how you're gonna build your business. So let's get into it and see how you can actually build up the business infrastructure. Okay, great. So I think the other part we need to be just make sure we understand is that the business structure is not going to make your business successful. However, the business structure is going to enhance and support your goals. So just always just go back to why did you start this business? How did you intend to grow it? And what are your strengths so that you can build from them, so that you find partners that are right and you build up the right structures for yourself to build up your business. Okay. So what are the learning objectives for today? The learning objectives that we're going to look at is look at the different types of businesses, but also to try to see within these structures, what are the advantages and disadvantages, and what are the tax implications and legal considerations that you need to be thinking about. Also keeping in mind, what's your personality, what's your natural talent. Consider looking at your network. And I think this is the most important one, that most of us as entrepreneurs, we generally do not pay attention. What is our network, so that we can choose the right partners. But also be very clear when it comes to the structure, what really are the things that will make your business successful? What will make, what actually is the structure that is successful, more successful within your industry, because industries are also not the same. Now, in generally, we have these 4 types, especially in South Africa. You can either choose to be a sole trader, or choose to be in a partnership, or you can also choose to be in a close corporation, or you can choose to be in a private company. A private company will be a PTY Ltd, but also incorporated. Over the last, I think about more than 5-6 years, close corporation is now treated the same as a private company in terms of requirements and the legislation. And there are no more close corporation businesses that can be registered. You can though continue operating as a closed corporation without converting it from being a closed corporation to private company. So let's look at the sole proprietor. A sole proprietor is basically just one person who has decided to start a business. That person must be a natural human being, a natural person, which means must be a human being. So you can't have a company that actually is called the sole proprietor. It's the person that get called that. Usually we find this type of structure in artists, in specialized area, in professionals. And the key legal consideration you have to think about in here is generally quite risky, because it doesn't separate your personal assets and the business assets. And also in terms of tax, depending on the revenue you actually generate, it might actually increase your tax, especially because the tax for company is limited at 28%, whereas for individual, it can go even as far as about 45%. When then it comes to partnership, the partnerships usually, again, is very much professionals, attorneys, accountants, doctors, auditors, and it works very well because it gets integrated to how the professional bodies look and assess in terms of code of conduct and things like that. And partnerships can actually also be a joint venture, and the partnership joining just 2 or more people who are there to carry out a trade. People may be demonstrating or contributing different skills or assets or resources, but a partnership can actually be up to 20 people. The sad part about partnership is not recognized as an entity. However, you can register it, but it's not necessarily recognized as an entity. And then the way you generally will register it, you will get a commissioner to actually stamp your agreement so that there is some sort of a legal standing of the document that you have. So in partnership, the parties are actually not separated, but also the individuals that are in that partnership must also be natural people. For the partnership to be valid, it must have a written partnership agreement that is enforceable, which express how the partners will actually operate. In terms of tax consideration and legal requirements, as I said, for legal requirement, there must be a written document. And also for income tax, the tax there is treated the same as a sole proprietor, which means each partner will need to complete their income tax, which is their return IT12, and also they will take a portion of both income and also the portion of the expenses and disclose those as separate within their income tax, but also the rates that they will be charging will range from, depending on the gross and the net of that individual person based on how their taxes are. So the rates will not be the same for each of the partners. And also each partner will need to register their own VAT and also their, for the receiver of revenue to be able to collect. I think about 2 years ago, there was also a requirement that even if you are generating director's fee or you are doing work which is form part of consulting work, when that work is above 1 million, you are supposed to actually register as for VAT as a VAT vendor. So now looking at the close cooperation, as I said earlier, I think about 2011, close cooperation could actually was stopped to be registered. So which then meant that we'll need to make sure that those who are close cooperation, they will now be treated as a PTY Ltd. There was a new Companies Act which then put that into effect. Now, when it comes to company, you have to register the entity as a legal entity, and it's a standing outside of the owners. It will need to have at least about 50 shareholders, and you will need to actually have contributed something, and such contribution will need to actually be in the shareholders agreement in terms of the requirements, but also the owners of which are the shareholders or the investors are separate from the actual business itself. Should that business die, the business will liquidate, but the shareholders' asset will not be affected, except the money that they have invested in that business. When it comes to income tax, the tax will range from 0 to 28%, depending on the type of or the size of that business. If it's below 20 million, they will be considered as a small business, which they will pay around about 7%. However, there are about 5 conditions that needs to be in place. Have a look at the video that I will link up on here. And in that video, I do explain those different conditions. And then if it's above 20 million, it will be up to 28%. Please note that 20% is related to nominal income tax. It does not cover dividends tax that may actually need to be added on that, or also it does not cover a CGT, which is capital gains tax. Now, let's just look at this in totality. So in terms of a sole trader, it is simple. It's easy to start, and you don't need to have the expert like accountants or auditors to do your accounts. And it requires bare minimum in terms of requirements. And you as an owner, you receive all the profit. And it's also easy to actually close down or discontinue the business. However, there are disadvantages. The owner is liable for all the business debt, but also the owner is solely responsible for raising the capital on that. And also generally, entrepreneurs, when you're starting, you will struggle with skills and finances, but also the business name is not protected. That is why it's also important, if you decide that you're going to start a sole proprietor, you're going to need to actually also register the specific name either of your product or of your business to be protected. And you can do that in different ways, as a trademark, or you can actually choose as a copyright in terms of that. So just analyze that and really look into that. And also the biggest challenge also with this is that should you work or you are an entrepreneur that run a business that is a sole proprietor, should something happen, either this incapacity or you die, that business will not continue operating. It will need to be closed down. So what are the things that as a sole proprietor you can do to actually make sure that you safeguard against these risks when it comes to your business? One, you have to make sure that you have a will in place. You also, in that will, you must specify what you want the business to be done about your business. You should also consider taking the product you have created or whatever that you've created, get it to be copyrighted or trademarked or whatever way of protecting that product or your asset. You must also try to make sure that you manage your debts very well so that, and your assets. And it might actually even be advisable to actually create a trust so that you can then, certain asset can be transferred to protect your assets should the business actually not succeed. So those are the few ideas that you can implement in dealing with these disadvantages when it comes to the sole trader or sole proprietor. Now, moving to partnership is very much similar to a sole proprietor. However, the only difference is that the partnership, it holds a lesser risk when it comes to continuity, because there will be also other partners. So yes, the partnership with those individuals, which is maybe could be 10 partners, does get dissolved, but it then gets to be technically, when someone joins, then it get incorporated. So a new agreement gets to be signed. When it comes to the liability, again, the liability is definitely not protected, which means then you really need to make sure that when you have partners, you select the right partners. And you also keep in mind and make sure that the partners that you are selecting, they live by the code of conduct. You have systems and processes to manage that. And you can also have some sort of a recourse within your current agreements. Please note that there are instances where you can get sued, even if you were not in the meeting, even if maybe one of your partners went into a contract without authorization. But what usually happens then, whoever that party that is suing, the partnership can decide to select few partners that he believes he can recoup money from. Doesn't need to sue the whole partnership. So partnerships are really quite risky. That is why it's always better to enter them within the same professionals, so that you make sure you manage that. Make sure also that your partnership agreements tie back to how the professional body that governs you guys actually manages and help you, so that you can really be able to have a muscle to deal with deficiencies that can come through, or things that can come through on the partnership. Now, coming to close cooperation, close cooperation is very similar to private company. The only difference with a close cooperation, should you decide to buy a close cooperation, since you can't actually register one, is that you can only have members up to 10, whereas a private company, it could be up to 50. And then it is a legal requirement, and it will need an accounting officer. And also the members' payments should also be disclosed and be shown, but also including distributable profit. So which means it works very much similar to the private company. The only difference is just the number of people, but also is it's just understanding that the ownership and accountability. But when it comes to a private company, the risk gets to be a little bit higher when it comes to requirements of governance, but also the management of that governance. So I think the only withdrawal when it comes to the private partnership is that you can't sell your shares public in terms of GSE. You can have actually prospects for people that you are looking for, but those prospects has to be limited in terms of what is it that you're offering and how you're managing that. Appointing an accountant or an auditor can also be there depending on what is sitting on your memorandum of incorporation, plus also what you have agreed on your shareholders agreement. Please note, both close cooperation will need to have agreement between the members, which is members agreement, and then whereas the private company will have the shareholders agreement in place. So in all, as much as you will have that legal structures, I think as an entrepreneur, you really have to think very hard on choosing which structure will suit you the most. Ask yourself, what type of a person am I? And look at your personality and see, okay, if this is my personality and this is the environment that I would like to play in, and this is the role I want to play, then what type of structure do I need to actually have? Always remember also, you focus on your natural talent, your natural energy. Look for people that suit your personality. You don't want to consistently be in clashes with people, but also make sure that your personality and your understanding of the environment in terms of character is quite strong, because I also believe that when you do not have a clear understanding of who you are as a person, you will also not choose the right partners that will actually build and assist you to build this business. You should also look into your network, find people that are worth finding, and I think this is one area that most entrepreneurs make. You should be looking for someone who's better than you in areas which you are weak at, so that that will make your business strong. Look at also people that you've put around you, including family members and friends. Just remember, they say the net worth of your business is basically the result of your network. Majority of my work, most of it, was coming from people who referred me the work. It was not just work that I went to the market to get. So just keep that in mind. Now, on conclusion on the business structure is that the structure will not make the business successful, as I said at the beginning, but it allows you to build the right foundation, so that when you're building up the business model, you're very clear on how you're actually going to do, but you're choosing the structure that is progressive, that can actually suit the size of the growth that you're looking at. But you should also keep in mind that each of these structures, they have a cost implication. Some of the costs are once off, some of the costs are actually annual fees. So you have to keep in mind. In the last 2 points is that irrespective of the structure you choose, you have to choose what will work better for you. But you also need to make sure that as you are choosing what will work best for you, consistently be assessing if you are not the main contributor on the business not growing. Always try to move yourself from the situation and ask yourself, if this was to happen, how will this work out? Be consistent in looking at building up your understanding on the areas where you're having a weakness, so that even if you do get a partner, there will be there will be some sort of succession planning within your organization. It's not just you 100% depending on whoever or whatever structure that you actually have built, because the structure then tells you how you're actually going to build up your team. And thank you so much, entrepreneurs. I hope you have learned 1 or 2 things on here. I will include this presentation, but I will also make sure that I include that section where we are actually talking about different tax implications on taxes, and also just have a look at how to build a team, because building up a team will also help you to build up a solid business model. Thank you. Bye.